We'll bring in the management at Titan now. Mr. S. Subramaniam is Chief Financial Officer of the company. He joins us from Bangalore. Mr. Subramaniam, thanks for joining us, sir. Good morning. Prashant here.
Morning. Morning.
Sir, fourth quarter has been disappointing, and I guess the full year has been pretty underwhelming as well. But let's just stick with the Jan to March period to start with. 23% fall on EBITDA, sir. 190 crores. Could you start there?
I think, Prashant,
what happened?
The problem is, EBITDA is one aspect. I think the problem is fundamentally at the top line. The revenues have been far below our own expectations, and for various reasons. As far as jewelry is concerned, I think, which contributes 80% of our revenues, we've had, unfortunately, a lot of issues due to regulatory reasons. Pretty much the whole of March was bad. Because while our stores were open, most of the industry was on strike, and that affected our sales as well, because many of our stores had to be shut during the month. And of course, the fact that consumers generally believed that the entire industry was on strike didn't help either. So March was pretty much a washout, and that I think we've lost significant revenues just because of that. You know that we also had the PAN card, 2 lakh PAN card starting from 1st of Jan. So to that extent, there was some impact of that as well. And then the fact that, of course, we had advanced our activation, our promotion to December this year, rather than have it around the mid-Jan, mid-February times. So some of that revenue also went down to the previous quarter. So I think there were various reasons why that happened. It's unfortunate. We are quite disappointed, frankly. But having said that, I think April is looking much better. April was much better, and hopefully things should start getting back on track now that the strike is over. Stores are up and running, and customers are coming in. So I think that's a good sign. Hopefully we should start seeing good growth going forward. On the watch side, of course, again, there was an issue with revenue there, where there also we had advanced the activation to mid-December. We also ran what we called end of season sale, rather not a graded activation, where we only discounted slow moving products so that we can get our inventory levels down, rather than a flat activation that we did last year, where all products are discounted at the same rate. We knew we would have to take a hit on revenues, but we were willing to do that. We just wanted to clean up our inventory and so on. Consequently, in the watch business, we also had to take some one-off hits at the gross margin level. That was about 20 plus crores, which we took. So that's, in a way, we cleaned up a lot of the businesses which were not doing too well for us. Some of the large format stores, we just had to shut down, take the stock right backs, and so on and so forth. So all that happened during this quarter. It's more of a cleaning up in that respect. Yes, very disappointing, but hopefully we are setting the base for a much better 16-17.
Right. Now the cleaning up is now done, sir? And could you tell us how many store closures?
Yeah.
What's
we
the
also had,
now?
for example, on the EBITDA, I mean, there's another issue we had, accounting inventory valuations, 20 crores gets pushed from last quarter to this quarter. So that was a hit again that we had to take because of inventory valuation issues as the sales were lower than expected. So the benefits of all that should come up in Q1 this year. Yeah.
So Q1 watches should be far better.
Not just watches, jewelry as well. That 20 crores I talked about was in jewelry. So that benefit should straight away. It's just a question of shifting by 1 month, and therefore that benefit should come in April itself, and that's what's happening. So you should start seeing a much better. We've been talking about a 15+% growth in jewelry that we expect to do this year, and in watches it could be in the 6-7% range.
Could you talk a little bit about margins, sir? I mean, and where you see them heading overall?
Yeah, as far as margins are concerned, actually we did a very good quarter in jewelry last quarter in Q4, despite the very low growth. In fact, frankly, no growth. We ended up with still 11.5% EBIT margin, which was exceptional, and that's because I think the gross margin has been quite good, and we've been doing that consistently over the last 1 year, despite the reduction in the making charges that we implemented from 1st of April 2015. So I think basically we are seeing people go up the value chain, buy more higher value pieces, and therefore margins have been quite intact. Of course, it helped that we didn't have the discounts from the Golden Harvest scheme for at least 8 months in the last year. So that also helped margins, but gross margins have been very healthy despite that reduction in April. So that's been a good sign. And this year, I think the focus is going to be on cost substantially. We've announced a voluntary retirement scheme which should be implemented this month, and we are trying to get our productivity levels up across all our divisions. So we are focusing on cost, but importantly, we do expect top lines hopefully to be much, much better.
You've always maintained that consumer sentiment remains pretty poor. No change in that, sir? The underlying conditions?
No, not we haven't seen much of that. Yes, because I think Jan, Feb were months where we generally thought could have been better, but sentiment has been poor. We've been talking about it even in March when we had our analyst meet that the quarter has generally been very weak. Forget the March impact of the strike, but even without that, walk-ins have been quite dull. So that issue I don't think has changed much. But hopefully we will start seeing some revival this year. Yeah.
You've bought a majority stake in an online jewellery company, Carrot Lane, right?
Yeah. We've got the approval from the board to acquire the majority stake, and we are at this point doing our due diligence, and we expect to conclude this. We don't frankly expect any major surprise in the due diligence, and hope to therefore conclude this by the middle of June. It's the leading player in e-commerce and jewelry segment. So it's a good marriage between a nice brick and mortar story like ours, Tanishq and Carrot Lane, which leads in the e-commerce space. It's a vertical, and therefore the business model is far more sensible in that sense that this is about profitability. They have good gross margins, revenue. We're not sharing the numbers at this point in time. And we will do so after the due diligence is over and the definitive documents are signed. But it's a business with very good gross margins, and the losses which are being incurred today are largely for advertising and brand building. So which is what would have happened in any other business. So I think it's a business which should be run the way normal businesses are run. Yeah.
Okay, fair enough. We'll leave it there. Speak to you when you're ready to announce more details for the company after the deal is concluded. Thank you indeed, sir, for joining us.